All right, Texas A&M, welcome here. You're the fourth team. Please meet the judges. I will start the clock when you start.
Wonderful. So good morning. Before we begin, we would like to thank all of you for your time today and the opportunity for us to speak to you. We represent Mays Business School of Texas A&M, and today we'd like to present our analysis of Cinemark. After a comprehensive evaluation of key economic and financial indicators, our team recommends a buy. With our target price of $34.12, which is an 8.3% upside to its current price of $31.51, and a historical 5-year average PE multiple of 19.4, our recommendation is further supported by its strong financial positioning, its high theater and economic resilience, and good constructive corporate initiatives, which are constructive and not wasteful capex. Our agenda is structured as follows. First, we will begin by discussing key corporate initiatives being undertaken by Cinemark, followed by our team's market research, financial analysis, and regression analysis of key economic indicators. Finally, we will discuss our evaluation of the company. With this information, we present to you an informed recommendation of our analysis.
Cinemark has been focusing on strategic capital expenditures, international expansion, and strong financial strength. With regards to their international expansion, Cinemark's international theaters generated over 20% of the company's total revenue in 2018. In Latin America specifically, Cinemark has a very strong market share in Brazil, Argentina, and Chile. Cinemark has theaters in 14 of the 20 largest metropolitan areas in Latin America. With regards to consumer behavior, Cinemark has been focusing on enhancing the consumer experience through their food and beverage concessions, their XD screens, and remodeling their theaters to have luxury lounge recliner seats. Currently, Cinemark has 56% of their luxury recliner seats in theaters, and they will continue doing so until they achieve 60% completion. In order to better understand the motion picture exhibitions industry, we conducted a survey. We had over 280 respondents, and these responses were consistent with Cinemark's corporate initiatives to stimulate growth, further developing our buy recommendation. 74% of survey respondents see at least 3 movies a year. 20% of respondents see more than 10 movies a year. And 93% of respondents will see the same number, if not more, movies in the future. 60% of survey respondents said they highly value luxury experience and accommodations. This confirms that Cinemark's focus on updating their seats to recliner seats is consistent with customer behavior. 62% of survey respondents said that they will purchase concessions when attending the movies. Currently, concessions is Cinemark's second largest revenue source, generating over 35% of the company's total revenue in 2018. Again, this confirms that Cinemark's focus on capital spending in this area is justified. Both Cinemark's corporate initiatives and our survey responses continue to dictate our buy recommendation.
Okay, so Cinemark has positioned itself really well financially, which we will illustrate through an analysis of the motion picture exhibition industry. So this graph shows us that this industry really comes down to 2 major players, and that's AMC and Cinemark. And despite the fact that the two companies despite the fact that AMC has a higher enterprise value, the two companies have a relatively similar operating income, which is illustrated through their enterprise multiples. So as you can see, Cinemark has a more favorable enterprise multiple at 6.3 versus AMC's 7.1, which suggests that the company might be undervalued. Now, excuse me, if we look at the earnings per share, again, you can see that Cinemark is head and shoulders better than AMC in this regard, with an earnings per share of $1.58 compared to AMC's loss of 19 cents per share. The same goes with return on equity. Cinemark has a return on equity of 12.6% compared to AMC's 2.9%. Now, this industry tends to be highly leveraged, which you can see here with AMC's debt-to-equity ratio of over 800%. Now, Cinemark, with the exception of IMAX, which is kind of a different beast in itself, Cinemark has positioned itself really well in the industry with a debt-to-equity ratio of 226%. And the same goes for liquidity ratios. Cinemark has liquidity ratios with its current equity ratios of roughly 90%, which, as you can see, is again head and shoulders better than its chief competitor in AMC. This suggests the company has positioned itself really well to pay its current liabilities, and especially when viewed with the enterprise multiple, the stability of Cinemark strongly suggests that the company is undervalued and supports our buy position.
Thank you. Now we will reiterate our buy recommendation through the dimension of macroeconomic indicators. By macroeconomic indicators, we refer to the outlook of the economy in the next 12 months and how it will affect the share price of the Cinemark. So, based on our extensive research, we found that there will be resilient US consumer spending in the next 12 months. The basis of this argument was the latest Federal Reserve report tabled in the February 2020, which says that the probability of recession in the next 12 months has been reduced significantly. This report also says that there will be increasing personal consumption expenditure as well as there will be increasing personal disposable income. So, the logical conclusion that follows is that if the economy is doing better, there will be a growth for the Cinemark holdings because there will be more people who will go to watch movies. But we have to quantify this relationship. To quantify this relationship, we conducted a regression analysis between the share price of the Cinemark and the consumer confidence index, which can be used as a substitute how consumers think about the financial situation in the country. And therefore, we found a positive correlation between these two. Therefore, if the consumer confidence index increases, there will be increase in the share price of the Cinemark. Similarly, on the other hand, we conducted another regression analysis between the disposable income and the share price of the Cinemark. And here also we found a positive correlation between these two. Therefore, based on our regression analysis, we found that if the economy is slated to grow, the share price of the Cinemark is also slated to grow, which further substantiates our buy recommendation.
Thank you, Madhur. Ladies and gentlemen, as my colleagues have outlined, we remain of the belief that Cinemark will reach our price objective of $34.12 over the course of the next 12 months. Using a WACC of 7.2%, our discounted cash flow model represents an underlying intrinsic value upside of 8%. Also important to note that it is apparent that Cinemark's strategic initiatives, impressive theater overhaul, and healthy balance sheet continue to prop up its industry-leading position. The company has shown through history that it can grow its revenue annually at 8% in good times and in bad. Conservatively, our model assumes 5% annual growth. As Cameron underlined for you, it appears that Cinemark employs a capital structure that is appropriate for its industry, and the company does not have any issue servicing debt payments. Going forward, our discounted cash flow analysis highlights the company's ability to maintain attendance levels and further develop customer engagement opportunities. As this slide shows, it appears that this is a cheap and attractive entry point into a stock with strong fundamentals and competitive positioning amongst its peers. DCF was our primary valuation tool, but our model assumes a very conservative price to earnings multiple based on history. We reserve the opportunity to raise our price objective if the company continues to deliver on earnings. Finally, I think it is important to note that the theater industry is highly sensitive to the film pipeline. Our survey indicated that over 60% of respondents' main motivation to go to the movie theater is a movie coming out that they are looking forward to. So in 2020, the film slate is pretty impressive, and there are a lot of major film names returning to the big screen. Some of these movies are Minions, Ghostbusters, Fast and Furious, amongst others. So given the current outlay, the motion picture exhibition industry continues to attract entertainment dollars of the U.S. consumer. Further, regardless of the longevity of this current bull market, Cinemark remains a entertainment destination. Perhaps in the event of an economic downturn, Cinemark would be a cheaper alternative to entertainment when discretionary dollars are harder to come by.
As with any recommendation, it's important to consider associated investment risk. A few investment risks include underperforming investment of NCM Incorporated, substantial long-term lease and debt obligations, seasonal fluctuation of operations which are associated with the industry, and finally, intense competition for patrons and film licensing. However, we believe that these risks can be mitigated by an effective and competent corporate governance. In conclusion, our recommendation is a buy, and we would like to thank you from Texas A&M University, and now open up the floor for questions.
Can you talk some about the long-term macro environment, the growth in box office, growth in individuals seeing movies and pricing of those tickets?
Sure. So I'll just start off. We've seen, despite the major shift to online streaming services such as Netflix and other platforms, that attendance has remained relatively unchanged. Also, it appears that as the macro environment changes, the entertainment industry, specifically this industry, can kind of be a scapegoat when things are more expensive. As we mentioned, it is a cheaper alternative to other forms of entertainment. So macroeconomically, there are obviously a lot of influences on this industry. However, we don't necessarily find that there are specific events that dramatically shift attendance levels.
I would like to add to some points. Like, this industry is not very much influenced by the macroeconomic indicators. Even in the period of low growth, this industry has shown sustainable revenue. This industry is not as other industry like cyclical in the nature. So we would say, like, if the economy is doing good, it's very good for the cinema and they can utilize that opportunity. But if the situations are not doing good, there will be not a shock that cinema have to face.
I didn't notice that you mentioned the loyalty program that they have. What is your take on that? Is it working? Is it not working?
Yes, ma'am. From what I understand, Manali, you can continue as well, but they had, I think, over 380,000 registries for the loyalty program, so they believe that it is effective. Also, they found that there are discounts associated with the loyalty program, so people are going to the concession stands more at the 20% discount that they get. So they're actually, they're not losing money on those discounts that they offer for the loyalty programs because people are actually buying more.
Can you just differentiate between their program and AMC's program?
I can't necessarily speak to AMC's program, but I can say that the pricing has been pretty competitive. So if you look at some of the monthly costs associated with Netflix or other online platforms, it is around the same price per month.
And also based on our customer survey, most of the survey respondents said they were not necessarily aware or interested in the subscription program. And so that's another area where Cinemark could be targeting more and potentially generating more revenue.
Ask you about your survey. So where did you conduct that? And how were you assured that you were kind of getting a representative sample of their customer base?
So we are all from other parts of the country, and so when we disseminated the survey both to A&M students and faculty and family members, we were able to get a good geographic diversity and age range in doing so.
Yes, sir. So we also recorded the demographic information for all respondents. So we looked at income level, we looked at gender, we looked at geography, amongst other things, and we found that there was a relatively balanced score across the board, and we thought that it was, a sample of a population. We thought it was fair in our analysis.
I was just going to ask you about their international mix. So, I know that they've been expanding in Latin America, and do you think that that is a strategy that has different risks associated with it as opposed to what their core strategy has been in the United States?
Yeah, I could definitely speak to that. I think, Cinemark has had a presence in Latin America for many years, and they have a huge market share, #1 in multiple countries, including Brazil and Argentina. And they've, including the management team, they've mentioned that, regardless of the political climate and different economic, climate, and factors that are going on in Latin America, it has not affected operations there. So it continues to sustain, despite political turmoil, and they continue to be self-sustaining.
Do they have
I'd like
any?
to add some points to it. Recently in 2018, the revenue was down for the Latin America because of the political instability. But the Cinemark has found out there were the area how we can earn more revenue from this Latin America is that they need local content. So they are investing more in the local production houses interacting more with the local distributors so that they can take the advantage of the growing population over there. And further adding to that, there are some, with the international expansion, there are risk of the currency, like the fluctuation of the currency. For that, they are focusing mainly in the local currency, like their transactions are mainly in the local, not in the dollars.
So do they hedge? When they bring it back, do they hedge the risk?
I mean, currently they are totally like based on their 10K information. They say that like they take into account that information while submitting that information to the SEC. But initially they do not they do not make, I would say, like regular transaction between the two currencies because they have established a presence in those countries for more than 15 or 20 years.
And when they're acquiring new locations in Latin America, do they acquire specific areas or how is their growth path in Latin America?
It depends on, and you can continue, it depends on the mall developers. A lot of it is leasing. And so, based on the different patterns of how they're developing their infrastructure in a state is how Cinemark comes in.
Yeah, I was just going to add, you're definitely targeting your cities, Buenos Aires, Santiago de Chile, Sao Paulo, those cities. So you're looking for those areas where there is, growth, but also percentage of the population that has the income to go to the movies.
So they're doing like, they're building the facility or they're buying a location from another operator?
It's the majority of leasing.
It's leasing and then installing, they're not.
Yeah, I mean they're acquiring the stuff as well as they are investing in the new theaters as well. Like they're acquiring the location because for this industry it is very important to be competitive because if there's a location, if there are no other competitors, you can go first. But it's very natural that other competitors will come if it's a very viable investment. So they're investing, they're going with both routes, as well as investing, as well as leasing the properties or on a rental basis.
How much stock does management own?
I do not know specifically. I believe Mark Zerardi is the largest stakeholder in the company, but I'm sorry, I have to follow up. I do not know the shares count.
You know his age?
My guess is he's anywhere between 45 and 55 years old, but I do not know specifically. He seems like a pretty young man.
In your opening comments, you said that it's citing the fact that they were doing smart but not wasteful CapEx. Can you tell me what that means?
Yeah, sure. So one example of that would be, they recently did a recliner initiative where after doing analysis of, what the target segment was, the target segment, they found out that they value luxury and accommodation. And so what they did was they invested in, adding recliners to about 60% of their theaters. And so that would be an example of constructive initiatives and not wasteful CapEx. And so
I think to add to that, they're trying to apply a little bit of Pareto's law here. You have, the 80-20 rule. So applying to those higher, those people that are willing to spend more, even if that means reducing the number of seats in the theater. So I think that's what we mean when, adding to that when we're saying smart CapEx spending and trying to monetize each seat a little bit more.
Looking at the investment risk page, and are these the largest risks you see to this investment, or are there others that are larger?
I think these were just a few notable investment risks that, kind of caught our attention. Looking at a 10K, there's, 7 pages worth of risk, but some of them were more minor and maybe not as, prevalent to Cinemark as it would be for the industry as a whole. And so I think the underperforming investment of NCM Incorporated, that was a investment risk that was kind of brought up in the investor presentation as well. So that's, someone, investors are looking at this and wondering, how that's going to affect company operations. So yeah, these would be just more investments that caught our attention.
I would like to add to that, like these are the major investment risks because they were mentioned very strategically in the 10K. Otherwise, there are many other like political, economical, which we have not mentioned, but these are the main risks we would say, as Sunny has already told about, like these were the most prominent that we came across.
And
How is management mitigating the substantial long-term lease and debt obligations?
I mean, right now, this industry is heavily leveraged, but Cinemark is already placed at a good place. Currently, if we consider the study period of this competition, it's like for the 12 months, they have a huge debt for like 1.8 billion, but they only owe 6 million in the next 12 months. So it's not it's not they're really concerned about the next 12 months for the debt. Their maturities are very far away. Currently, the maturity for the next 12 months is just 6 million. And to take into account the long-term debt obligations.
Okay, all right, thank you so much.